Hello, I'm Rusty Tweed, the president of Tax Card 1031. In this video, we're going to be talking about the relationship between risk and cap rates. Just like with any investment, the higher the risk, the higher the return, the lower the risk, the lower the return. You're going to find that the risk varies quite a bit depending on the area that you buy your property. For example, here in Los Angeles, Santa Monica is considered a very low risk area. If you buy an apartment over there, it's probably going to pay about a 3% cap rate. Now, if you move over to the San Gabriel Valley, it's considered a little higher risk. You're probably looking at a 4, maybe even 5% cap rate. Now, if you go down to South LA, which is considered a much higher risk area, you're probably looking at a 6 to 7% cap rates. And again, the higher the risk, the higher the reward, the lower the risk, the less the reward. Now let's talk about cap rates according to different parts of the country. Let's take Starbucks for an example. Now, this is actually a property that we tried to buy for a client recently down in Orange County, which is a very strong affluent area. And this came in at a 3.75% cap rate, which is low. Now, if you move over to somewhere like Kansas, which is considered a little higher risk, we're going to see a 5% cap rate. Moving over to Jacksonville, Florida, that same Starbucks is about a 5.5% cap rate. And again, if we move over to Indianapolis, which is considered a little higher risk, we're going to see a 6.5% cap rate. So again, all these are very similar properties. They're all Starbucks, but according to what part of the country you're in and what kind of risk is in that area, we're going to see a different cap rate. Now let's talk about cap rates according to different types of property. For example, if you take a triple net lease property like a Walgreens, which is considered very, very, very low risk, you're going to have a lower cap rate. Let's just say 6%. If you go to an apartment building, which is considered a higher risk lease than it is with a triple net lease, that's going to be a higher risk and you're going to get a 7%. Going into something like an office building, which is considered probably one of the riskier types of investments in real estate, you're going to get, again, a higher cap rate, in this case, maybe 8%.